Right now, as you're watching this, the global economy is being held hostage by a waterway so narrow you could swim across it, 21 miles wide, that's it. And whether the United States slides into a recession in the next 60 days may come down entirely to what happens in that stretch of water. The Federal Reserve just held its most important meeting of the year. Goldman Sachs just raised its recession probability. The IEA just called this the largest energy supply disruption in the history of the global oil market. And this morning, an Iranian military spokesperson mocked U.S. ceasefire attempts and said, quote, "You are negotiating with yourselves." This is the full picture, let's get into it. To understand where the U.S. economy stands today, you need two things running in parallel in your head. The first is the war. On February 28, the United States and Israel launched joint strikes on Iran. Iran retaliated by closing the Strait of Hormuz, the narrow waterway through which roughly 20% of all global oil normally flows. As of today, March 25, that strait has been effectively shut for nearly 4 weeks. Tanker traffic has dropped by over 70%. More than 150 ships are anchored outside the strait, waiting. The second is the Federal Reserve, which met 1 week ago on March 18 and made a decision that locked the direction of U.S. monetary policy, at least for now. These two things are colliding in real time, and understanding that collision is the key to understanding what comes next for your money. Last Wednesday, the Federal Reserve voted 11-1 to hold interest rates steady at 3.5 to 3.75%. That was expected, nobody was surprised. What mattered was everything around the decision. The Fed's so-called dot plot, the internal forecast where each official marks where they think rates are headed, showed that 14 of 19 officials now expect just one rate cut or zero this year. Coming into 2026, markets had been pricing in 2 cuts. That window has narrowed significantly. Chair Jerome Powell stood at the podium and said something that should have gotten more headlines than it did. He said, "The forecast is that we will be making progress on inflation. Not as much as we had hoped. Not as much as we had hoped." From the Fed chair. That is not a reassuring statement. That is an admission that the inflation fight is not going as planned. He also updated the official economic projections. Inflation forecast raised to 2.7% for 2026, up from 2.5% in December. GDP forecast nudged slightly higher to 2.4%. Unemployment held at 4.4%. On the surface, those numbers don't sound alarming, but here's what matters. Those projections were built on data that existed before the energy shock fully hit. They are already stale, and within days of the meeting, Goldman Sachs had already revised its own numbers, raising its headline PCE inflation forecast to 3.1% and cutting its full-year GDP estimate to 2.1%. The Fed's own projections and reality are already diverging, and it's been 1 week. Let me put the energy picture in terms that are concrete. Before the war started on February 28, Brent crude oil was trading around $70 a barrel. As of today, after a brief spike above $126, it has pulled back to around $100 to $101. After Trump announced a 5-day pause on strikes against Iranian infrastructure and said talks were productive, oil fell nearly 11% in a single day on that news. But here's the problem. That oil is trading near $101 even with a ceasefire glimmer on the table. If talks collapse, and the Iranian military is publicly mocking those talks as of this morning, oil goes right back up. The IEA has called this the largest disruption to the energy supply in the history of the global oil market. Not since 2008, not since Ukraine, ever. Hormuz flows have collapsed from 20 million barrels per day down to a trickle. Gulf oil producers, Iraq, Kuwait, Saudi Arabia, have had to curtail output because they've run out of storage. There is nowhere to put the oil. Goldman Sachs now expects Brent to average $105 in March and $115 in April, assuming roughly 6 weeks of disruptions. If the strait stays closed for 10 weeks, Goldman says daily Brent prices will likely exceed their all-time 2008 record level. The 2008 record, let that sink in. Gas prices at the pump have already hit the highest level of either of Trump's presidential terms. AA puts the national average at over $4.25 a gallon, and that's before the full pipeline of diesel and energy costs works its way into food, manufacturing, and logistics, which takes 3 to 6 months. The inflation data you'll see in June, July, and August, it's going to reflect what's happening today. Here's the thing that makes this moment so dangerous for the economy. The Federal Reserve is trying to manage 3 simultaneous problems, and the tools they have can only address one at a time. Fire 1. Inflation. Already running hot before the war. Before the strait closed, inflation was already sticky. The Fed's preferred gauge, core PCE, was running at 3.1% in January, well above their 2% target. February's producer price index jumped 0.7% in a single month, the biggest monthly surge in a year. Tariff inflation from earlier in the year was still flowing through the system, and then the oil shock hit on top of all of that. Fire 2. A labor market already deteriorating in February. The U.S. economy shed 92,000 jobs. Not added, shed. The unemployment rate sits at 4.4%, near its highest level in 4 years. And the detail that concerns economists most, 16 of the last 19 monthly payroll reports have been revised lower after the fact. The last time we saw that frequency of downward revisions was 2008. The labor market is weaker than the headlines suggest. Fire 3. An energy war with no off switch in sight, and now layer on the oil shock. The Dallas Federal Reserve's model projects that the Hormuz closure will knock 2.9 percentage points off annualized global GDP growth in the second quarter alone. 2.9 percentage points. If U.S. GDP was growing at around 1 to 1.5% coming into this quarter, and that's the current estimate, that math takes us into negative territory. So here's the Fed's impossible position. Cut rates to help the labor market, inflation gets worse, and it's already re-accelerating. Raise rates to kill inflation, you push a weakening job market off a cliff. Hold steady and do nothing, the economy slowly deteriorates while you watch. That is exactly where they are sitting today, at 3.5 to 3.75%, frozen. Let's answer the question directly. Is the U.S. already in a recession? Officially? No. A recession requires 2 consecutive quarters of negative GDP growth. The Fed's own forecast is 2.4% growth for 2026. We are not in a technical recession today, but here's the honest answer. Goldman Sachs has raised its recession probability to 30%, up 5 points in the last week alone. RSM pegs it at 30%. Moody's Analytics has crossed 50%. J.P. Morgan's Bob Michel has explicitly warned the oil shock is not a speed bump, and that price pressures could remain sticky far longer than markets are pricing in. Goldman's own models now show U.S. growth cooling to just 1.25 to 1.75% in the second half of 2026, what economists call stall speed. That is growth so slow that any additional shock tips you over. And here's the uncomfortable truth about recessions. By the time they're officially called, you're usually already several months in. The National Bureau of Economic Research, the group that officially declares recessions, typically makes that call 6 to 12 months after the fact, which means if a recession begins in Q2 of this year, you won't hear it officially declared until sometime in early 2027, but your paycheck, your grocery bill, and your gas tank will know long before that. I want to spend a moment on this because it's the part most financial coverage is missing. The reason this economic moment is especially dangerous isn't just the risk of recession, it's the combination of recession risk and inflation risk at the same time. That combination has a name: stagflation. Here's the plain English version. Normally the economy runs on a thermostat. If it overheats, inflation rises, the Fed turns up rates to cool things down. If it goes cold, jobs disappear, growth stalls, the Fed cuts rates to warm things back up. Stagflation breaks the thermostat. You have rising prices and economic stagnation happening simultaneously, which means every single tool the Fed has makes one problem better and the other problem worse. We've been here before. In the 1970s, under Fed Chair Arthur Burns, policymakers tried a stop-go approach, hike rates to fight inflation, then cut to prop up growth, then hike again. The result? Inflation stayed entrenched for an entire decade. It took Paul Volcker pushing rates to 20% in the early 1980s and triggering back-to-back recessions to finally kill it. Jerome Powell knows this history. It's why he used careful language last week. He is not going to be the Fed chair who lets inflation expectations become unanchored again, but holding rates while the labor market deteriorates has its own cost, and the people paying that cost aren't hedge fund managers. They're the workers losing jobs in a low-hire, low-fire market that's now tilting toward low-hire and starting to fire. Let me quickly run through what markets have been signaling since the Fed meeting. Equities sold off on decision day and have stayed under pressure. The VIX, Wall Street's fear gauge, remains elevated above 20. That tells you professional investors are actively hedging against downside. Bond markets have moved to price in zero rate cuts for all of 2026. Not one, zero. That's more hawkish than even the Fed's own dot plot, which still calls for one cut. The bond market is saying, we don't believe inflation comes down fast enough to give the Fed room to move. Gold has been volatile around the $5,000 level, pulling back from its record highs. The structural bull case, central bank buying, geopolitical risk premium, inflation hedge demand, remains fully intact. The pullback is paper market noise. Oil is the one trade that has worked in 2026. Energy is the only S&P sector that has consistently outperformed. If you want to understand who benefits in this environment, follow the drillers and pipeline operators. Bitcoin is sold off with the broader risk-off move. In crisis periods, it behaves like a high beta risk asset, not a safe haven. That pattern is holding exactly as history suggests it would, and today, March 25th, stock futures are climbing on reports of a potential US-Iran diplomatic framework. Oil has pulled back toward $100. That is what a resolution signal looks like in asset prices. Watch this space. Here's a layer to this story that isn't getting nearly enough attention. Jerome Powell's term as Fed chair ends May 15th. He is being replaced, pending Senate confirmation, by Kevin Warsh, a former Fed governor and Wall Street veteran who has been nominated by President Trump. Here's where it gets complicated. Powell has stated publicly that he will not leave the Federal Reserve's Board of Governors while the Justice Department investigation into the Fed's headquarters renovation is ongoing. A judge already threw out the DOJ subpoenas, ruling they were a pretext to pressure Powell on rates. Pirro has vowed to appeal. Senator Tillis has put a hold on Warsh's confirmation pending the investigation's resolution. So here's the scenario. Powell may still be running the Fed in June, possibly July, during an active war, during a historic energy shock, with a rate decision that could make or break the economy, and no clarity on who is actually in charge. Markets hate uncertainty more than they hate bad news. A policy vacuum at the Fed, layered on top of everything else, is its own source of volatility, and when Warsh does take over, his stated plan is to cut rates while simultaneously selling the Fed's mortgage-backed securities aggressively. Cutting with one hand, tightening with the other. Nobody has tried that combination in an environment like this. Goldman Sachs still expects 2 cuts in September and December, but the timeline is entirely dependent on how long the Hormuz disruption lasts. Here's the honest framework for thinking about what comes next. 3 paths. Real probabilities based on today's data. Scenario 1. Diplomatic breakthrough. 20% probability talks between the US and Iran, currently involving Vance, Rubio, Witkoff and Kushner, produce a genuine ceasefire within the next 2 to 3 weeks. The strait reopens. Oil falls back toward $80 to $85. The energy shock is absorbed. Goldman's 2-cut scenario plays out, September and December. GDP holds above 2%. Stocks recover in the second half of the year. Soft landing preserved. This is possible. Trump has signaled positive talks. Oil already fell 11% on Monday's announcement. The market response to a genuine deal would be explosive to the upside. But as of this morning, Iran's military spokesperson is publicly mocking the negotiations. The probability is real, but not high. Scenario 2. The grind. 45% probability. The conflict drags on through April and May. Oil stays in the $95 to $115 range. The energy shock feeds into consumer prices with a 3 to 6 month lag. GDP slows to 1 to 1.5%, unemployment drifts toward 4.7 to 5%. The Fed stays frozen. Warsh eventually takes over and delivers one cautious cut in Q4. Markets stay range-bound, down 5 to 15% from highs for the year. Technically not a recession, but the kind of economy where the average person feels like it is one. This is the base case. Painful, but not catastrophic. Scenario 3. Full escalation. 35% probability talks collapse. Iran's new supreme leader Mojtaba Khamenei, who has publicly vowed to keep the strait closed, follows through. Oil breaks 130, 140, 150. The Dallas Fed's model, which already projects a 2.9-point GDP hit in Q2 from current disruptions, gets far worse. Consumer spending collapses. GDP goes negative in back-to-back quarters. Unemployment spikes above 5.5%. The Fed is paralyzed. S&P falls 25 to 35% from its highs. Credit markets seize. Global recession follows. Goldman has explicitly said, if the strait stays closed for 10 weeks, daily Brent will likely exceed its all-time record. This is not a tail risk. Goldman Sachs pegs overall recession odds at 30% and rising. Moody's is above 50%. We are not talking about fringe scenarios here. Here is your real-time dashboard. 4 numbers. Watch them daily. Number 1, Brent crude oil. Today it's near $101, pulled back on diplomatic noise. If talks collapse, it goes back above $110 quickly. $130 is the danger threshold. $150 is a crisis. A genuine ceasefire announcement drops it 10 to 15% in a single session. Oil is your single best real-time signal for where this goes. Number 2, diplomatic signals from Vance, Rubio, Witkoff, Kushner. Not Trump's Truth Social posts. Look for statements from the Iranian Foreign Ministry. If Tehran says anything other than total rejection, that's a green shoot. If the Iranian parliament speaker keeps saying the strait won't return to its pre-war status, which he said this week, that's the opposite. Number 3, March payrolls. Released. April 4th. February was minus 92,000. If March is also negative, that's 2 consecutive months of job losses during a war and an energy shock. This report will move markets significantly. Number 4. The 10-year Treasury yield. Currently around 4.2%. If it rises above 4.5, the bond market is pricing an entrenched inflation, bad for stocks for growth reasons. If it drops below 4.0, the bond market is pricing in recession fear winning over inflation fear. Also bad for stocks, but for a different reason. Watch the direction, not just the number. Here is where the United States economy stands on March 25, 2026. The Federal Reserve held rates last week, the right call given what they knew at the time, but the data since that meeting has darkened. Goldman has raised its inflation forecast, cut its GDP outlook, and raised its recession probability all in the same week. The energy shock is larger, faster, and more disruptive than any model had priced in at the start of this year. We are not officially in a recession. GDP is still positive. The NBER has not declared one, but the probability of ending 2026 in 1 has risen meaningfully in the last 30 days. Moody's is above 50%. Goldman is at 30 and climbing. The margin between the soft landing and the hard landing has never been thinner. The single variable that determines which world we live in is not inflation data. It's not the Fed. It's not even Warsh. It's a 21-mile waterway off the coast of Iran. And as of this morning, the people who control that waterway are telling the world they're not done yet. Stay close to the data. The next 2 weeks are going to be critical. If you found this useful, share it with someone who needs to understand what's happening right now. And, if you want the next update as this situation develops, hit subscribe. See you in the next one.